then we also looked at these key things. We had also considered from the analysis of this from the long and the short. Somebody is saying she cannot hear. Who else is not able to hear?
For me,
am I audible?
For me, it is okay.
Yeah, maybe the one who is not hearing, you leave and join again with the mic on. So I hope we covered that. Everybody appreciates payoff, profit, break-even, etc. from the point of view of the long and the short. That's a very important objective, which if you don't attain that learning objective, then the rest will be more chaotic. Because we are actually building on that we have covered to escalate now to valuation models. Valuation models.
Yes, Malim, excuse me.
Yes.
This is my first time I'm joining the class. Kindly assist me with how can I get the notes?
Are you on the virtual learning platform?
Yes, I'm virtual, yes.
Everything is there.
Okay, thank you.
Yeah, I've put the notes.
Mm.
And also cut 1 and 2, they are now available. I'm just going through them to verify that there are no errors.
Oh, okay. Is the cards on due, Ama? There is days which are remaining.
The cards will be available from tomorrow.
Okay.
When you click, you will see.
Okay, thank you. Now, WhatsApp group for the class?
We have a WhatsApp group.
Oh, kindly someone to add me.
You can inbox me if you have my number, then I will be able to add.
Okay, I don't have your number, please.
Someone can write it. Let me write it in the chat.
Okay, thank you.
If you are joining for the first time, you might have challenges. So I don't know what can happen because I'm seeing 56 participants, but people have been consistent. They are about that 7. So, and what we have already covered is important. So I don't know. You need to ensure that you grasp these things so that.
Okay, Malim, I'll go through the notes, then we'll catch up.
Yeah, just go through the notes.
Okay. Okay.
Where you have challenges, you can side chat me. We see how we can resolve.
Okay, thank you. When did the class start?
The class starts at 6.
No, not this one, but the previous classes. Which date?
We are now in the 5th week or 6th, something like that.
They were telling us to wait up to October, so the class will start. I don't know why they did that.
Okay, let's discuss with you outside this class.
Okay, okay.
Yeah. So members, I think I'm clear that we have covered all this in terms of the basic principles of valuation of options, both the call and the put option. I think I'm very clear about that. Today, I wanted to begin the valuation models. I think my license now, I have no problem with the timing. It's now renewed into perpetuity. So I would like to introduce Valuation. Let me see whether this thing is in the notes. Binomial. And these things are very important. People who disappear and later on come. They are just quoting. Boss Mwangi is also not hearing. What is wrong? Mwangi, I think it is your mic. Let me check. If you can't hear, the problem could be your mic. So you leave and join again with the mic on. That is the little I know about these things. So let me I'm not, my handwriting is very bad. Option evaluation models. We have the basic classifications. There are just two. One is the discrete time model, which is basically binomial option pricing model. Then the other classification or category is the continuous time model. Let me just a minute. So we have the two classifications, the discrete time model and the continuous time model. So I can just leave and maintain one. So in this class, I would like us to begin with the discrete time model. later we'll be able to analyze the continuous time. Basically, or roughly speaking, continuous is just an approximation of discrete under a very small time horizon. If the time horizon is very small, then it's an approximation of, it's a discrete approximation of continuous. So the two are quite related. Just as we are going to see, for those of you who have done a bit of financial management, or you have a background in finance, or somebody saying there are no questions posted in the assignment. Yes, it is true. I will post. Also, cards have posted questions, but they'll be available from tomorrow. I'm still reviewing them to ensure that there are no errors. And remember, just as I had said before, the questions I've said, the quizzes are multiple choice, and the questions are based on the derivative markets and instruments, that set of notes. So if you want to answer the questions, you read only derivative markets and instruments. There are 2 quizzes. Each quiz is 10%, but there are 20 questions for 45 minutes. So a total of 40 questions. So remember to read thoroughly before you attempt, since only 1 attempt is allowed. Only 1 attempt is allowed, so you better be very sure. So I was trying to say that the 2 sets of models are related. For discrete, we shall study binomial option pricing model, which I should cover today. Then for continuous, we will look at the Wiener process, or the Wiener process, or Brownian motion. Then we look at Black model. We shall extend also continuous time model to cover the Greeks, or the Greek letters. That is it. So let me introduce and probably begin looking at the discrete time model.
Okay, Doc.
Yes.
Just for clarity, I don't know which topic are we learning in the coursework?
Yeah.
Which topic are we learning today in our coursework, in the course outline?
If you look at the course outline, which one do you think?
I don't know, I'm seeing something like valuation in topic 2.
There?
Yes.
Evaluation.
Yes.
We are not on that one.
Which one are we, Doc?
It's like we are on a binomial. You know, the concept I'm covering, it is valuation models. It's not coming out clearly as valuation models on the outline.
Okay.
But it is valuation models. The rest we covered. We covered the 3 week 3 to 6. If you are looking at the course outline,
Yes.
where it is written valuation, basic valuation, we covered that one. Is there an item that we did not cover? Those who are there, just a
It's okay, Doc.
Okay, sorry. Yeah, the course outline at times we don't follow it strictly, but we end up covering it. So I've just called this one option evaluation models, which according to this guideline, it is a binomial model and block model. So it appears I'm moving very fast. But the Greek letters and ethos lemma might take us time. It has a lot. And also the models. Each of these model might require a week or a full lesson. Black model might require 2 lessons. So roughly speaking, we should be able to finish everything by mid-November if we cover everything. So allow me then to go back to discrete time model, which I said in this category, we are looking at binomial model or binomial option pricing model. Now, in this model, we are going to look at the fact that if you have an underlying as your stock or the stock as your underlying, we can even call it stock price. This stock price, you are going to observe it at various points in time. You have your current price, which is SO. You can observe it for 1 unit of time, maybe after 1 day. If your observation unit of time is days, then after day 1, you will have this price going up or going down. That's after day 1. After day 2, it could go up further so that SUU, this time it could go down SUD, or it could go down further SDD. So the thing can continue. It can continue like that. Yeah, so that you end up having a binomial forest. You begin with a binomial tree, then it can have very many branches until it is now a forest. But the thinking is here. The original reasoning that can be replicated is here. So that if you are here, the other thinking can be here or here. Yeah, it can continue like that. Yeah. So that these circles will always have subsets, union or intersections. Yeah, like that. So you can have another circle like that, another circle coming in here, another circle coming in here, like that. So given a good opportunity, you can draw a binomial tree, then you superimpose on that binomial tree some sets so that we can use that to now do valuation of okay, we are predicting the value of the underlying to the very end. Then we can use the price movement of the underlying to now derive, because a derivative depends on the value of the underlying. So the value of the underlying, as it changes, the value of the derivative will also change. So the value of the derivative will basically mimic the price movement of the underlying. And that is how the binomial concept is coming in, that the price movement shall be binomial in terms of distribution, or of course the outcome at the end of each period is binary, either up or down, either yes or no, either 0 or 1, like that. So because the outcome is binary at the end of each period, we approximate the price distribution as binomial. Are you seeing? That's how the word binomial is coming in. And you don't need to worry, we shall go very slowly so that everyone at the end of the day, you will attain the learning outcome, which is to understand how to estimate the value of an option using binomial model. If you can do that, then the objective is attained. And of course, it must be attained. That's why I come in. So I can now say, now that you understand about the characteristic of a binomial thing, that the outcome at the end of each period is binary, then we can start by saying that assume the current price is SO. So let's begin with only one period, so that any other number of periods are replication of one period. You only extend. So when you are here, the original price is SO. The price can go up 1 to become SU there. It can go down to become SD after observation 1. Of course, maybe for demystification of the argument, we can also extend it to at least 2. 1 can be misleading. So the fact that after one period, it went up, it could go up further at the end of period 1. No, at the end of period 2, it could go up further, or this time down, so that it is SUD, which should be like that. SD, if it goes up, it becomes that. If it goes down further, it becomes SDT. Yeah, so that is how the thing behaves. So as price moves like that, the price of the underlying, the price of the option on this underlying will also mimic the price movement of this underlying. So it will have a certain value in those triangles that I have included. So the usual problem is, how do we know that the price will move, the price O will move to SU? How do we know? And even if we know it might move to SU, by what percentage will it increase to SU? Or SO moves to SD, by what magnitude? And what is the probability that it will move? So that is the thing now we need to establish here, the probability of the price moving upwards, and by what extent, what percentage is it likely to move? Yeah, so that is it. So before we go into the process, we can have some assumptions. Assumptions of this binomial. I don't know whether I'm orderly in doing so, but before we now delve into the process of binomial pricing, we can have assumptions of the model. One assumption is that there are no no transaction costs, which is an element of efficient market, no transaction costs. The other assumption is that no limits on the quantity, and no limits on quantity traded. So you can buy any number of shares or sell. There are no limits. Of course, practically, we know limits exist. Like in Nairobi Securities Exchange, we know we have limits. You cannot just buy or sell on the exchange more than 65%. A significant percentage that may cause significant change in shareholding. You cannot be allowed to buy or just sell without approval of Capital Markets Authority. But for theoretical reasons, we are saying that no limits on quantity. Then the other remarkable assumption is that trading happens only at discrete times. Trading happens, I hope I'm communicating. Trading happens only at discrete times. Is it clear when we say discrete times? It means that you trade at specific times. Like you open at 9 a.m. When does Nairobi Securities Exchange close? For instance, you open at 9 and close at 3. Those days, that's how they were operating. Those are discrete times, which is the opposite of continuous. Continuous means you trade online, so that it's every time. So trading, if it is continuous, it means every time. And that only happens if it is online. That can only happen if it is online. Then the other assumption is that the principle of no arbitrage applies. The principle of no arbitrage. No arbitrage. What is arbitrage? Someone to tell us? The principle of no arbitrage applies. What is the meaning of arbitrage?
Commission.
Buying from one market that is low and selling at in another market that is at a higher price. Therefore,
Yeah, actually, arbitrage is making money without investing anything. So in arbitrage, you don't pay anything; you just make money. Like you just make calls and make money. For instance, the hawkers, what the hawkers do in the CBD is just arbitrage. They take umbrellas from a vendor in the streets, in the shops. They leave a security there, or they are known themselves, they are a security. They pick the umbrellas. They are told to sell at any price, but bring me per umbrella maybe 300 shillings. Then they are told, sell the price you want. Then they agree that we shall sell at 1,000. So they all go to the street and start saying, umbrella Nangiri, Ivo. Then they sell. So each umbrella they sell, they are making 700. So they only need to sell one umbrella to close the business, or two. They close the business. So they have made like 1,400 without investing. That to me is arbitrage, because the rest cannot reach the guys, the original suppliers cannot be accessed. It's only the hawkers. Yeah, so in a securities market, arbitrage can happen so that somebody capitalizes on the price differential and makes money without investing anything. Even in currency, if one person is selling currency at this price, another one the other price, you just make orders. You tell this person, I want to buy $1 million. Then you tell the other guy, I want to sell $1 million. Then you connect the two and get the difference. So that is arbitrage. So in brief, we are saying that in modeling using binomial, there should be no arbitrage opportunity. If arbitrage opportunity exists, then the model collapses. Yeah, I hope it is clear. So the model itself is such that we have one, the price jump upwards, then two, the jump downwards. Of course, in mathematics, we have a process called the jump process, which in this case, it's going to be a binomial process, which has two outcomes, either upward jump or downward jump. So the model works on those two outcomes. And then we have two possibilities. So at time one, for instance, after one observation, either 1 week or 1 day, it depends on your frequency of observing the price changes. So your frequency will determine how to do things so that the price at this time, S1, has two outcomes. So we can just mathematically say it is SU or SD. This is if price goes up, and SD if price goes down. Yeah, two possibilities.
Since unaona mtoto amelala ni kama umemwambukiza malaria. Ni kama umemwambukiza huyo mtoto malaria. Wala mchana.
Yeah, I've muted. That is the problem with the online. Yeah, so we have it that way. So the function, the price function can be summarized as I've done it, that it's going to be SU if price goes up, SD if price goes down, such that SU is equal to U times SO. We already know that SO is the price at the beginning, and SD is equal to D times SO. There are two parameters I have introduced here, two parameters. These two parameters that I have introduced are such that maybe I can just say U, D are constants. Remember what we are doing, it may not be in the notes. Notes have only theoretical things, most, and things you can explain in English. But here, I'm going into the details of the binomial, which you'll not find in the notes. That's why you need to be very careful and also follow step by step. So U and D are constants such that U is greater than 1 is greater than D, which means D is less than 1, isn't it? And D is greater than 1. So they shall be fixed. U and D, if they are fixed, they are a constant, then they will be fixed for the entire period of analysis. Then later on, we'll find a way of deriving what is this one and what is D. We shall find a way of finding those. So I would like to derive some functions here. So that you will later on see when I introduce exponential R, there is another element so that D must be less than exponential ER must be less than U. So there is this exponential R. R is the risk-free rate that makes arbitrage opportunities to be eliminated. So there is a certain risk-free rate which is used to regulate the market ability to engage in arbitrage. Yeah. So that risk-free rate is very important. It connects the two. So we will see where it is applied. But I would like to go into some more details. So the thing we have just done here is the price process, the basic structure. This is the basic structure of the binomial model, which now we can simply put it this way. In a binomial tree, we can have SO times U and SO times D. So that is the basic structure. Very important, this basic structure. And this is actually one period or a single period binomial model of the stock price. So this is a single period binomial model for the stock price. So in brief, you can say this is a simple binomial tree with only 2 branches. So we are considering only the time interval from 0 to 1. That's why it is called binomial single period or one period binomial model. But remember, let me now escalate the discussion. Somebody is asking me the recording. The recording, my license has a problem with the recording, but I think you can record on your side. Although these slides I can share with you if you are not able to write. You know, some people are using a phone to attend the class and they have no other writing, they have no notebook, they have no whatever. So it is becoming difficult to follow. So for you to attend an online class effectively, it's good if you have a notebook and you are on a screen, you can see. Our phone is too small to see unless your eyes are very sharp. Or a laptop, that is the ideal for online learning. You needed to invest in additional resources, which you have saved through traveling. You see, if it was face-to-face, it could be more costly because you spend money to travel to class, etc. So somebody saying, I can't access notes of the virtual. Let's engage those who have issues. Can we engage after the class? You can call. You can call me. I'll give you about 5 minutes to engage after the class. So the stock price ST is assumed to be a random. The other name for random is stochastic process. Yeah. The stock price ST is assumed to be a random or a stochastic process, which means it can assume any value. Nobody knows. Can we tell even the price of Safaricom tomorrow? Can anyone guess? End of tomorrow, what will be the price of Safaricom? Can anybody tell? No. Nobody can tell. Even in fact, the longer the observation period, the less the possibility that you cannot tell. Yeah, it becomes more difficult with the time. So stochastic process. So that mathematically speaking, over any discrete time interval from t minus 1 to t, from t minus 1 to t, st either goes up or down. St will either go up or down. And this is the formal now presentation of the binomial model. We are arguing that the stock price ST is a random process or a stochastic process, meaning it can assume any value which nobody knows. But over a period of time, t to t, t minus 1 to t. T minus 1 means one step after what we have. So that if t is 10, then it means we are observing the stock price at day 10. Then this is t. Then 9 therefore will be t minus 1. So if you are at t minus 1, then you are moving to t. The price, associated price, will either go up or down. If you are moving from day 9 to day 10, at the end of day 9, the price will either be going up or down. So nobody knows. That's what we mean by being a stochastic process or a random process. And it goes without saying that we cannot predict, we are not going to be able to predict, we are not going to be able to predict the value. But what we know for certain is that it will either go up or down. That one we can say with 100% certainty that the price will either go up or down. What we don't know by what percentage, that is another paradox. That is another paradox. So I hope up to here we understand the binomial process. So our job here is to be able to attach a probability. We need now to attach a probability to U. What is the probability? Probability of U, which is a P. Then probability of D, which is of course probability of D. In this case, we may use 1 minus P because the two outcomes are mutually exclusive and exhaustive. The two events are exhaustive and are also mutually exclusive. If it goes up, you cannot say it also went down. So the two events are mutually exclusive and are exhaustive. If that is true, then if you are given P, then the other outcome will be 1 minus P. I believe you understand that as a straightforward fact. So allow me to move then to, we are still escalating our discussion on binomial model. we can move to the cash process. We want to use this argument of binary outcome to build some portfolios that will help us to develop functions for P and 1 minus P. Are you present? I've seen a few lefting.
We are present.
We are present, Daktari.
Okay. Yeah, let's go on with this
Tupo.
escalation. This escalation, so that you have an idea what is this thing, this animal called a binomial model. Of course, the basic structure you have already seen it, either up or down, and that if it goes up, there is a probability associated with it going up, and also the magnitude of or by what extent it goes up, by what extent. Is it 10%? Is it 3%? Is it 90%? You know, anything can happen. So we need to derive those probabilities. And the best way I derive these things is by creating portfolios. Because you are a finance student, I like going back to portfolios. So the cash, so I can now introduce a process called the cash process. The cash process. So here we argue that if we have money, any investor who has money besides stock, we also have bonds. We also have bonds. Let me complete the sentence. Besides stocks, we also have bonds. So someone can invest the money in a bond or even a deposit account. Deposit account. Isn't it? See, if you have money, instead of investing in the stock or in the share of a company, you can also put the same money, instead of the stock, you can put in the bonds or even bank deposit. So those are possible competing options or competing opportunities for your money. So if you invest in the bond or deposit the money in the bank account, the value of the money at time T is going to be PT. If you invested at T is equal to 0, that is at the beginning of your time. So we can also assume that this money is risk-free, and we'll assume that it earns interest at the constant risk-free rate, continuously compounded per annum. So this money which you have, which is PT, to get its value at PT. So its value at PT is going to be continuously compounded value. So if it is a single unit of money, then it's going to be exponential for a single unit. It's going to be exponential. Yeah, it is going to be. So exponential, no, let me put here T. Exponential RT. So it's the compound value of, we are assuming that you have 1 unit of money. So its value at BT is just the compound value of the money at the beginning. So that R must be greater than 0. So interest-free rate cannot be negative. So that PT is greater than PO, which is 1. And BT minus 1, or just BT is greater than BT minus 1 for T, of course, for T is greater than 0. Of course, time, you cannot go backwards. So we assume that that BT will increase. BT value increases in a predictable manner. Of course, we can predict. Because already we have said that it is given by this. That's what we have said. So it's predictable. Once you know T, you can get the value of BT. Because it's cash. You know, the value of BT is not a random process, isn't it? It's only the stock price, which is a random process. This one, if you put money on a bank account and there is a fixed rate you will be earning, then the value, it should assume it's known in the future, isn't it? There is no randomness there. Same applies to the investment in a bond. Value of the bond, it's known. It's known. So the only thing that is now competing for your money is the stock, which is the stock whose price is a random process. So you have a choice to either insist and invest in the stock, or you can put your money in the bond, that is a treasury bond, or bank deposit, both of which are just investments. They are debt instruments, I mean. So I hope at this point the argument is still very sensible. Yeah, if the argument is still sensible, I can move to another slide. In this slide, I would like to advance another argument. Just a minute. Let's break for 5 minutes. Yeah, a break of only 4 minutes remaining or 3. We can resume. Hello.
Mwalimu, are you on?
Oh, so sorry. We can resume and finish. So I was trying to I want now to formally introduce something from our previous discussion that at time t, at time 1, I mean, after one period of time, the same portfolio, the same portfolio will be, you see, remember we had a portfolio of now the stock and the bond or cash deposit, whatever the case. So the value at time 1 is going to be either some quantity, we don't know how many, what can I say? We can say A, which is a number, let me use lowercase a times SOU plus B, which is a certain number of bonds you have bought, times exponential R, because T is 1. This is if stock I've not drawn properly, but it is if stock price is up. If stock is up, stock price is up, and it will be a certain number of shares or stocks times this plus a certain number of bonds exponential if stock is down, yeah, if stock price is down. Of course, the initial initial cash in the account was ER. So that we have a portfolio which contains, so the portfolio which we are referring to here contains, of course, contains shares, and what? And the bonds in whatever quantity. So we are going to choose, so we can choose the spelling of choose is what? We can actually choose the value of A and B. We can choose the value of A and B in order that the portfolio replicates the payoff of the derivative, no matter what the outcome of the share price process is. So the share price process is a random variable, is a random process. So to now immunize our portfolio so that we can fix its value regardless of the stock price process, we can choose A and B. We can choose A and B. So that now the two portfolios, if we choose A and B, let me go to this other. If we choose A and B, we will have two portfolios. So V1 can be either C subscript U. I'm now introducing something else. This is if the price goes up, and it's going to be CD if the price of the stock, of course, the price here is the price of the stock, goes down. So that now A times A SOU plus B exponential R is equal to C subscript U, and A D plus B is equal to CD. Yeah, so there are two equations I have formed. There are two parameters which we'll need now to find a way of dealing with them, such that the price, the equation 1 and equation 2. Equation 1, if the price of the stock goes up. Equation 2, if the price of the stock goes down. So what do we need to do? So the choice of A and B therefore ensures that the value of the portfolio that contains A and B at time 1 is equal to the derivative payoff. Of course, we are just saying this CU and CD, it's the derivative payoff, assuming we are talking about a call. So the call value is going to be CU if the price goes up, and the call value is going to be CD if the price goes down. If we are now assuming the option we are referring to, the default option is our call. Hence, if that is the case, hence by the no arbitrage principle, if there is no arbitrage, the value of this portfolio at time, at the beginning, at the onset, the value of this portfolio, so value of the portfolio which contains A and B at time zero, of course its value being this, must also be the value of the derivative contract at that time must also equal to CO. The value of the contract at that time must also be equal to CO. Of course, we know that the value of the call option at the onset is CO. So if we can solve the simultaneous equations 1 and 2, we can find A and B. Then we can determine the value of CO, which is the value of the call at the onset. You see, this animal is what we finally need to do. If we can solve for CO, then we are done with the binomial pricing model, because our obligation is to say what is the value of the call at the onset. That is it. That is where the game ends. So this model that I'm trying to advance, the model being advanced here is referred to as the binomial tree. It's actually a binomial tree. And each of the parts, mali simiti zinapitia the nodes from SO to SOU and from SO to SOD. Are branches. These are just branches. Kizungu ya kawaida, they are just branches. So that we shall be having the up branch. So we shall be having the up branch. Then the down. We shall be having the up branch and the down branch. Then the junctions. So at the end of each branch, we shall have the nodes. Mahali sinakutania mahali another branch starts, or the end of one branch. It's nodes. Yeah. So in order to avoid, to avoid arbitrage, then we must have this, that D must be less than exponential R must be less than U. If that is not the case, what will happen? Because someone can say, explain what will happen if this is not true. If D is not less than exponential R is less than U. If that does not hold, what can happen?
Excuse me, Mwalimu, could you move your screen up a bit so that you're able to see?
Screen.
Yes.
You know, it's not movable. You know, it's just who else is not seeing? Maybe it's your screen. Are you using a laptop or a phone?
I'm using a laptop.
Yeah, then you should see, because I think if I check,
Okay, it's okay now.
you can view.
Yes, I can see now.
There is the last statement, which is very critical. I was trying to explain that D must be less than exponential R. Exponential R must be less than U for arbitrage opportunity to be avoided. If that is not true, what can happen? That is the question. If this is not true, this is what can happen. So if D is not if D is less than this fails, or if it's not true, then this can happen. That is in case exponential R is less than D and D is less than U. What can happen? You can borrow, then we can borrow 1 or 1 shilling, whatever currency, 1 of cash, We can borrow that cash. You borrow 1 shilling, then you buy one shilling of stock. You invest 1 shilling in stock. Yeah, you borrow 1 shilling and invest that shilling in the stock. At time 0, what happens? So at time 0, what will you have? You have borrowed 1 and invested 1. So what is your net worth? Is 0, isn't it? Because you will have okay, net cost at time 0, net cost. The net cost is equal 0. Has it cost you anything? So at the onset, you have invested, but what was the cost of your investment? You didn't invest anything, because the 1 bob you invested in the stock is not yours, you borrowed, isn't it? So your net worth is, okay, you put 0, in other words. That's why arbitrage now exists. At the onset, you invest nothing. Your net cost is 0, but you have invested. So at time 1, what will be the value of your portfolio? No, it will not be 1. At time 1, the value of your portfolio will be what? Either D minus or U minus, that is the value. Either D minus the bond, or U minus the value of what you borrowed. It will either be D minus that or U minus that. So this is an example of arbitrage, because either way, it will be greater than 0. Because we know that, of course, so in brief, we are saying that generally, if an asset, or if one asset, e.g. the share, is certain to earn more over the one step than the other, or cash, then we simply borrow. If we are sure that the price will earn more, the share will earn more, then we simply borrow the other asset to invest in it as many times as we can, thus making an arbitrage profit. The only way to avoid this scenario is if the share performs either better or worse, then the cash then the cash will be, the cash you need must be, D must be less than exponential R, and exponential R must be less than U. I think this with an example now, with the figures, more detailed figures, we shall be able to demonstrate. Let me not make it worse. Let me see where to solve for A and B. I don't know where were those equations. So the two equations, let me see where I had. I want to revisit. Ndio nijue tutasimamia wapi. There are two equations I had developed. Not those ones. Yes, these two equations. I think these ones we shall solve them next week, but we need what is A? We want to solve for A. Can somebody, this can be your assignment. You can try to solve A. Solve for A. Somebody to try and solve for A there, so that next week we pick from there. So the bottom line, where we shall reach, I've created the maximum number of slides. Bottom line will be to solve for A and B, so that A will give us the number of shares you should buy and the value of bonds that you should invest, B, which is B, so that CU is equal to CD. Yeah. So there is a way we shall force CU to be equal to CD by looking for a certain value for A and B. And that's what we shall be able to do next week, is to get A and B. Which will help us to find P, which is probability that the price will go up as exponential R minus D over U minus D. That will be the probability that the price goes up. Then the other one will be the probability that 1 minus P will be the probability that the price goes down, which will now be used to equate on equation 1 and equation 2. So that is the job we shall do next week, so that we derive what we call risk neutral probability of the price going up and risk neutral probability of the price dropping. So once we have P and 1 minus P, then it's possible to now start evaluation of the put or the call option using the binomial tree. So I think for now we stop there, but we shall pick that argument next week. Meanwhile, try to ponder on how to solve for A and B. Let's break. We'll meet next week. Meanwhile, before we go, let me show you something on the quiz. The quiz. I hope it's not open. Yeah, it's not yet. Yeah, so these quizzes,
The quizzes will probably open up tomorrow, the 12th.
yes, the quizzes open tomorrow.
All right.
So before someone attempts, it will open at 5:14 and close. Okay, I'll change the settings so that the quizzes open at 6 tomorrow and close the following day at 6 as well. Or I can even extend to midnight. So it will open tomorrow at 6 p.m. because most of you are working. So 6 p.m. So you are free to attend anytime up to Tuesday midnight. So that is the settings I want to make. So meanwhile, let's meet next week to escalate the issue of binomial model.
Doc,
Thank you. Yes.
Daktari,
have you added any term paper on the virtual campus?
Not yet. I'm going to add. They will be available from tomorrow.
All right.
Yeah, assignment is only 5 marks. No, 10, 5 each. Then term paper is just term paper is very significant. Term paper I might take time to upload. I may upload towards the end of the month because it needs to cover significant work that we have done. So term paper might.
Will both quizzes open at the same time and close at the same time?
Yes. The two quizzes are related. They are almost similar questions, so that we take the average of the two. The questions are almost, I draw questions from the same database.
Some things we have already covered.
Yeah, I had already told you the scope of the quizzes. The scope is only on the derivative markets and instruments only. And of course, multiple choice. So do not read things which will not be tested under quizzes. Read only derivative markets and instruments, then you attempt.
Daktari.
Yes.
Under assignment 1,
in
the virtual campus, you had posted the term paper, which had instructions you attempt only one question.
Is it posted?
It was posted on 12th September. Which,
yes,
and it's due 27th October.
The
term paper.
Oh,
assignment
term paper
1.
is already there. Oh, yeah, I had forgotten. It is there. Actually, it is there.
Yes, you. Yes.
Mwalimu, that's not a term paper. Looks like some calculations.
Kwani term paper?
No.
Term paper doesn't mean
Just
there are
check
no
the
calculations.
instructions.
What do you understand by the term paper?
You know, it's something you can research on.
Yes, but this is quantitative, so you can also research on this one. You want term paper in derivatives to be like in communication or marketing.
Yeah, that's what we are used to. We are not.
It depends on the subject.
Okay.
Yeah, the term paper for this one is this one.
All right.
Yeah. So
we proceed with that one.
Yeah.
So
you
kindly.
answer, let me see. Having a mistake. You answer any one question.
No, it's okay.
No, I'm going to change it because it's not adding up to the number I wanted. I'll pull it down and change. So do not attempt. I'll change it because of an error of addition. I'll make an adjustment. Sorry.
Okay, thank you.
Okay.
Okay, thank you.
Doc,
Yeah. Wacha tuonane next week.
Daktari,
Yes.
kindly clarify about the slides or the notes for revision purposes.
I'll forward them to the Moodle. Let me convert them to PDF and share.
Thank you.
Okay.